Two markets, same system. Gold at $4,565 on COMEX, Shanghai paying $4,600 plus, silver at $74.21 on COMEX, Shanghai paying $78.55. The physical market is pricing both metals above the paper market simultaneously, with APR silver first notice day arriving in 5 trading sessions. OG John AG here. Drop OG John AG in the comments if you are here paying attention and actually learning. Now, the paper versus physical divergence across gold and silver is the widest it has been in this cycle. Let's get straight into it. Before we go further, if this kind of data-first analysis is what you have been looking for, hit the like button right now. Subscribe to OG John AG 1.0 and share this with one person who needs to see these numbers. Now, back to the data. Lead story today. COMEX paper markets versus global physical markets. March 26, 2026. Gold COMEX spot, $4,565. Shanghai Gold Exchange equivalent in USD, above $4,600. Premium, $35 to $50 per ounce. Silver COMEX spot, $74.21. Shanghai Gold Exchange Ag T+D equivalent, $78.55. Premium, $6.34 per ounce, 8.6% above the paper price. This follows a historic collapse in both metals from January 2026 all-time highs. Gold from $5,594.82, silver from $121.67. The paper markets sold off hard. The physical markets in Asia did not follow at the same rate. That divergence is now visible and measurable in real-time SGE data. The timing is what deserves scrutiny, not the sell-off itself. The timing. Think about what that sequence actually means. Paper markets collapsed on Western macro pressure, dollar strength, yield spikes, forced liquidation. Physical buyers in the East stepped in and are now paying a documented premium above the paper price. When has that happened and not eventually resolved upward, with paper catching up to physical? The ones paying attention already know what to watch next. Before I show you the full data picture, consider this. A ratio above 5 times paper to physical has historically been associated with elevated delivery risk on COMEX. Silver's current ratio is 7.0 times, 557.9 million ounces of paper claims, 79.2 million ounces of registered deliverable metal. The last time this ratio was at 7 times with a coverage ratio below 15%, heading into an active delivery month. The price moved with force. The data is already telling you something. Let's build it out. Now let's build the full picture because this divergence does not exist in a vacuum. The CME Group Daily Warehouse Stock Report, the official source, shows COMEX registered silver at 79.2 million ounces as of March 20, 2026. Eligible silver at 252.9 million ounces. Total vault inventory, 332.1 million ounces. Open interest from CME, 557.9 million ounces. Coverage ratio, 14.2%. COMEX stress. Index 82 out of 100, high stress. Registered silver dropped 10.8%, 9.6 million ounces in the past 30 days alone. Eligible silver dropped 9.7%, 27.1 million ounces, in the same period. Both pools declining together. On the gold side, the Shanghai Gold Exchange is settling above $4,600 USD equivalent, while COMEX holds at $4,565. JP Morgan maintains a year-end gold target of $6,300. Deutsche Bank holds $6,000. UBS holds $6,200. Not one of those targets has moved post-correction. Meanwhile, leveraged funds and commodity trading advisors have been net sellers of both metals since January. Strategic money holding, tactical money selling. The ones who have been dismissed for pointing at the leverage ratio, they are not saying much right now. That is not coincidence. That is a pattern. And here is what makes that picture even harder to ignore. Gold, $35 to $50 Shanghai premium over COMEX. Silver, $6.34. Shanghai premium, 8.6% over COMEX. COMEX silver open interest at 7.0 times registered supply. Coverage ratio at 14.2%, below the critical 15% stress threshold. APR 2026 first notice day in 5 trading sessions. At the same time, the DXY at 99.66 and 10-year Treasury yield at 4.35 to 4.39% are actively suppressing the paper price of both metals. That is not a contradiction. That is the setup. Physical buyers paying above paper prices while paper markets are suppressed by macro headwinds. The structural tension between those two realities cannot hold indefinitely. And before anyone takes that as a green light, setups can take a long time to resolve. The Shanghai premiums have existed for weeks. The coverage ratio has been declining for weeks. Neither has triggered a squeeze yet. What this tells you is the structural picture. The timing is a completely separate question. Anyone who claims to know the timing is selling something. Now the macro variable, because the Federal Reserve and the US-Iran conflict are no longer a backdrop. They are the primary variable. Here is the number most people are not connecting directly to metals. The same fiscal expansion driving the 10-year Treasury yield to 4.39%, defense spending, infrastructure, energy security, is simultaneously consuming silver and satellites, communication systems, electronics, and weapons guidance. The U.S. defense budget expansion is a direct silver demand driver. DXY at 99.66 suppresses COMEX paper silver. The same government driving the DXY up through dollar-denominated debt issuance is also procuring silver-intensive defense hardware. The contradiction is structural. Federal Reserve Chair Kevin Warsh has held rates at 3.5 to 3.75%, with no pivot signal for 2026. Markets are still pricing both metals primarily as non-yielding paper instruments, subject to yield headwinds. Look at the 8.6% Shanghai physical premium and tell me what probability you put on physical industrial buyers caring about the Fed funds rate. When industrial procurement demand starts pricing the reality of what COMEX warehouse data is actually showing, silver reprices upward. Gold, as the institutional safe haven layer, reprices alongside it. That is the historical pattern. Every time physical premiums of this scale have persisted against paper markets in a delivery month approach, it has not been different yet. Gold COMEX Western spot at $4,565, Shanghai equivalent above $4,600, a $35 to $50 premium. Silver COMEX Western spot at $74.21, Shanghai Ag T+D at $78.55, a $6.34 premium. The short-term picture across both metals is this. Both are sitting on physical floors while paper ceilings hold from DXY and yield pressure. The resolution event is binary. If Friday closes with gold above $4,500 and no negative geopolitical escalation, Monday opens with a base building case toward $4,700 on gold and $78 on silver. If Friday closes below $4,450 on gold with Tehran maintaining its denial of peace talks, Monday gaps down on both metals at the Asian Open before New York can respond. That is the only short-term read that matters right now. As for trading it, I cannot see a clean picture on the lower time frames right now. I cannot tell you what either metal does Monday morning. Nobody can. If you think you know, good for you. This is a market with a geopolitical binary overhead, a DXY at 99.66, silver at 7 times paper leverage, and APR first notice day in 5 sessions. Sidelines is not weakness in this environment. It is the only edge there is. I have called this market both directions. I will call it again when I see it clearly. Right now, I do not see it clearly. The tape decides, not me. Here is the honest truth. Both sides of this trade have a real case, and the one you ignore is the one that will cost you. So let's run both. The bear case is real. 1. DXY at 99.66 is a documented ceiling on USD-priced gold and silver. Every approach to 100 has suppressed both metals in the current cycle. 2. Federal Reserve Chair Warsh has explicitly ruled out rate cuts through 2026, keeping opportunity cost of non-yielding metals elevated at 4.39% on the 10-year. 3. If 85 to 90% of APR silver longs roll forward as historical norm, the squeeze thesis does not activate and silver retests $66 to $68. The bull case is equally real. 1. Shanghai gold above $4,600 and Shanghai silver at $78.55 confirm physical buyers are paying above COMEX paper prices right now, verified in SGE settlement data. 2. JP Morgan at $6,300, Deutsche Bank at $6,000, and UBS at $6,200 have not revised gold targets post-correction. The strategic money is holding its structural view. 3. COMEX silver coverage ratio at 14.2% with 5 days to APR notice day represents the narrowest physical backstop against paper claims in recent cycle history. Size correctly. Know what you are in before you are in it. The physical market already knows where this is going. The paper market is still arguing. That argument does not last forever. 2 prices for the same metal, in gold, in silver, simultaneously, right now, in live market data. Shanghai above COMEX on both. The structural pressure is already built across both metals at the same time. The only question is when the paper market catches up to what the physical market already knows. Don't take my word for it. Verify every number I gave you today. Check the data yourself. CME Group Daily Warehouse Stock Report at cmegroup.com. Shanghai Gold Exchange at sge.com.cn. U.S. Federal Reserve H15 release at federalreserve.gov. Logic over hype. Always. If this analysis added value, like this video right now. Subscribe to OG John AG 1.0 so you never miss a data drop. Share this with one person who needs to see these numbers. The ones running the OG John AG 1.0 playbook do not wait for the mainstream to catch up. They already know. OG John AG 1.0, out.